Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. With interest rates back at more normal levels, the investing landscape is returning to a state we haven't really seen since before the global financial crisis. Today, I want to look at what this means for asset allocation, and who better to talk to than one of Australia's biggest super funds. In 2022, Sunsuper and QSuper merged to create Australian Retirement Trust, managing more than $260 billion in retirement savings on behalf of 2.3 million members. Additional smaller funds have since merged with ART, including the Australia Post Super Scheme, Commonwealth Bank Group Super, Alcoa Super, and a deal to manage funds at Woolies. So, this is a pretty big fund. In fact, I'd almost call it a mega fund, that not just combining the different investment strategies of Sunsuper and QSuper, but doing it in an environment that we probably haven't seen for about 15 years or so. Andrew Fisher is the head of investment strategy at Australian Retirement Trust. Andrew, welcome to Fear and Greed.
Thank you, Sean, and thank you very much for having me. It's very exciting.
I want to talk to you about asset allocation and strategies, things like that. But first, how do you take a bunch of really big two mega super companies, and put them together? And then you throw in a few of the corporate super funds. Just like, that's quite a big deal to get everyone on the same page.
Yeah, it is quite a big deal indeed. And I think it's reassuring for us, and it's good for us to have sort of done this once or twice before. There's a level of match fitness, I think, in bringing together large portfolios of assets. And so it is a big deal. It's a huge thing to be working through. It's exciting for us, I think, as a team to work through something like this. It's probably one of the biggest things that's happened in our market. Yeah. If you think about sort of $200 billion pools of assets coming together. And so there's a lot of challenges to overcome, but they're also exciting challenges. I mean, you don't get opportunities like this very often. So, we take a thoughtful and sort of constructive approach to how we make the best decisions, but you have two really thoughtful and high-performing investment capabilities coming together, bringing the best of each of them and finding that, extracting it and putting it together, we can make something quite amazing, I think.
Okay, when you're investing that much money, though, even that in itself is difficult. And if you think of the ASX, and you've had sort of super companies taking Sydney Airport, for example, and stuff like that off the bourse, just finding the opportunities is a challenge.
Yeah, it's certainly something we think quite a bit about, is anything we're doing today. So as long as I've been working Sunsuper prior to the merger at ART, we've kind of been on a trajectory of doubling in size every 5 years. And so the investment you make today, which seems appropriately sized for your fund, in 5 years is going to be half what you want it to be in the context of the fund. And so getting that thought process right and getting that mix right of, being forward-thinking enough to plan for your growth, but at the same time, not sort of overstretching and not getting enough diversification in your portfolio. It's a delicate balance that we're constantly challenged with, and we also have to evolve over time. Yeah. And so private markets is a really good example of that. You're right, Sydney Airport is something we participated in as ART in terms of that privatisation. That's not something we were doing 5 years ago in terms of taking private directly off the ASX.
Okay, so that's a pretty good segue into the sorts of assets that you look at. And in a sense, this is kind of a more general discussion rather than ART specifically. It is the role in this new interest rate environment, new at least post-2007, where rates are more like they used to be, albeit a touch higher, but not a lot higher. The role that bonds play, credit plays, equities plays, alternative assets, which 15 years ago, some of the alternative assets that we are thinking about today just weren't even available 15 years ago. So how should investors kind of think about that big picture in terms of the roles that these asset classes play?
Yeah, I think there's an element of sort of back to the past a little bit with this. For those of us with a few grey hairs on our head, when we went through university, we were taught about an investment environment that looks something like this. Your standard assumption for interest rates when you were building a portfolio was something around 5% and bond yields around 5%. The past 20 years, as we've become accustomed to lower and falling interest rates, and that's sort of influenced the way we think about all assets and how we include them in portfolios. I think, while it might seem challenging, it's actually quite exciting to be in an environment where diversification is a lot easier than it has been for a long time. You probably use the expression Tina in this podcast, which is like there is no alternative. And essentially that was equities, because interest rates were so low, there was nothing else to do. With interest rates going back up, there's a range of things we can put in a portfolio in a diversified way, so we're not just so heavily reliant on equity risk to deliver long-term returns. And that's what we're sort of focused on at the moment.
Stay with me, Andrew. We'll be back in a minute. My guest this morning is Andrew Fisher, Head of Investment Strategy at Australian Retirement Trust. Okay, so let's talk about fixed income. Suddenly, bonds, government bonds, are interesting again because you're getting a better return. But then if you go out into credit portfolios and investment grade and then beyond, how do investors who haven't actually done a lot with bonds for a long time, because maybe they're defensive, but a couple of years ago they actually weren't defensive. So, how should they think about it going forward in terms of moving out the curve?
Yes, I think the first thing you really want to think about is recalibrating your principles and your thoughts around what a risk-free rate is. When you're in an environment where interest rates are 1 and bond yields are sort of 1 to 2%, your expectations from equities can be quite a lot lower than they otherwise are. And so when interest rates are 5, you've got to remember that you need to be expecting something like 9% out of equities for them to be offering you an appropriate reward for the additional risk that you're taking. And now for an investor like us, we invest globally as well. So this becomes another interesting sort of perspective is, well, what's the interest rate in the country in which you're investing in? So if another country has really low interest rates or another country has really high interest rates, they're generally high for a reason. And so you've got to make sure you're being rewarded for risk. And so starting with a sort of baseline of, well, some bonds in a portfolio at 5% return, 4% return today, but cash is 5 in the US. So if you can get 4 to 5% return from some relatively safe assets in your portfolio, and then if you think about equities, if you want to be at sort of 9% return for equities relative to that 5, credit should be somewhere in between. And so making sure we think about it in sort of reward for risk space. So bonds at 4 to 5, equities at sort of 8 to 9, then credit's probably sort of somewhere halfway or maybe a third of the way in between. That's as an expected return. So if we're confident with that return, that's how we can sort of diversify the portfolio.
Yeah, okay. So broadly, without holding you to those numbers, that's kind of par. That's what investors should be thinking. If I'm doing better than that, great. If I'm doing a lot below it, not so good. This is over a time period because we're talking about a longer period here.
Yeah, and you'll always find sort of structured things that someone will try and repackage things in a slightly different way to extract return. Generally speaking, the person that structured whatever that thing is together does it for their benefit, not necessarily yours as an investor. And so that's something we're always cautious of. If something looks too good to be true, there's probably is.
Okay. So what about assets like real assets? So infrastructure and REITs, real estate investment trusts, how do they fit into this new world? And then I'm going to ask you about alternatives, private equity and things like that. But let's start with the real assets.
Yeah, so real assets. So we think of it, and this is one of the benefits I think of being sort of large and at our scale where we can control how we use debt in those assets. And so if you think about an office building, for example, right, without any leverage, without any borrowing against the building, it's a pretty stable stream of rents, and it looks a lot more like a bond than it does an equity. Now, what you can do, of course, is you can borrow, and anyone would know this with their own house. If you borrow money against your house, the return on the small sliver of equity that you have in your house is magnified dramatically. That's how you make a much riskier version of that. And so when we think about real estate or infrastructure as a real asset in our portfolio, it's really how much debt is involved in that. So how much, is it more like equity or is it more like fixed income? So we call them mid-risk assets internally, and it's something we can actually control at our size and scale, at least, particularly where we own direct. We can actually control that so that it suits our portfolio.
Okay, and then you mentioned infrastructure there. What about some of those assets? You talked about Sydney Airport before. Is it the same deal because you are so big?
It is the same deal. We typically, I think what's sort of specific about the infrastructure space is we will tend to use leverage a little more because oftentimes you have some form of guarantee on the sort of top line cash flows. And so if you know your rent is guaranteed, it's a regulated asset.
Like a tollway or something.
Exactly. Tollways to an extent, but even utilities probably more so. Tollways are still a little bit sensitive to sort of the economic environment. In a recession, you might have less cars using a tollway, whereas electricity demand is generally fairly consistent.
So if you're talking about bonds being par at about 5%, equities being par at 9%, the credit curve somewhere in between that, where do things like real alternative assets, private equity and some of those asset classes fit into it?
Look, so I think I sort of outline a relatively simplified framework for thinking of it, because I think the simplified frameworks, there's always extremes, but simplified is a mid-risk asset, and we think it's sort of somewhere between equities and bonds. Then if it was a liquid daily tradable asset, then we'd probably put it at a 7% return if it's halfway in between. Now, then you need to ask yourself, is it a liquid daily tradable asset? And if it's not, am I being adequately rewarded for the fact that it isn't? And that's when we think about what we call an illiquidity risk premium. Is there a premium over that sort of liquid return that justifies us tying money up for an extended period of time? You can think of that like a term deposit for a year versus a month. Are you being adequately rewarded for tying your money up? And then when we think about it, we look for something like about a 2% excess return over and above the sort of underlying risk. So what that means is something like an infrastructure asset probably has the same return hurdle for us as equities to make it into the portfolio.
Okay, the moral to this story, though, is work out where your base case is, and with higher interest rates, bonds being your base case, that's 5% or 4% now, not 1%, and then you work the other assets off that. That's kind of the story we're telling here today. Is that right, Andrew?
Yeah, absolutely. And then also think about risk, and are you being rewarded? Is what we always think about. And if something looks too good to be true, there's probably a reason. There's probably some illiquidity wrapped up in there that you don't quite realize you're exposed to, or there'll be some other risk inherent in something that's been packaged in there that explains why that return looks better than it might otherwise look like for a traditional bond or equity listed investment.
Now, we're way over time, but I'm still going to ask you one more. Things like trends. So digital infrastructure. Everyone wants a data center at the moment, or ESG, energy transition, those sorts of things. As an investor, how do I'm not asking you where to put my money. I'm just saying, how should I approach these mega trends, which seem to be, am I going to buy NVIDIA? Probably not, because it's too expensive for me now anyway. How do I think about these things?
The first thing I always think about with this is, am I at the back end of the trend or the front end of the trend? Because if you're at the back end of the trend, you're probably helping someone who got in at the front end get out at a nice, tidy profit. And so the first thing we think about is like how much legs there are to run in the trend. How is the thematic playing out? COVID's a really good example of this. We had all these accelerated trends come through markets, and things that were supposed to take 7 years happened overnight. I think the AI trend has a little bit more sort of length to it at this point, but you're right, these things all look incredibly expensive, and so they will invariably find their way into prices very quickly. One of the things we try and do is, if we are getting towards the back end of a trend, is try and think about, well, who are the second order winners then? So a good example of this, which is something we were invested in, is if you think about the move from retail to online shopping. First stage of that is warehouses. The second stage of that, though, which we had an investment in, is sort of robot infrastructure to sit in the top of a warehouse and pick things up and move them around in a private equity investment. And so having the foresight, if you want to invest in a trend, is not just like, not the vanilla, but like what is all the periphery around that trend. Even if you're not able to get in the early adoption, you might be able to find some opportunities around the edges.
Yeah, I was talking to an investor the other day who'd gone heavy into air conditioners for data centers.
Yeah, exactly.
Andrew, thank you very much for talking to Fear and Greed.
No worries. Thank you very much for having me, Sean.
That was Andrew Fisher, Head of Investment Strategy at Australian Retirement Trust. This is the Fear and Greed business interview. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Have a great day.